Welcome to the deep dive. We are cutting through the noise today to get to the core of what's happening with one of the most volatile stocks on the board, SoFi Technologies, ticker SOFI.
Yeah.
It has been an absolutely brutal start to 2026 for shareholders, especially after, that huge run-up at the end of last year.
It was such a sharp reversal. And I think for investors who just saw, a 40% gain in the back half of 2025, that rapid plunge in early January had to be shocking.
Exactly.
So our plan today is to go deep into the source material. We're talking internal movements, analyst reports, those aggressive financial targets, and to really answer the core question.
Which is?
Is this sudden significant drop just market hysteria, normal volatility, or is it a structural red flag for a company that's aiming for a nearly unimaginable trillion-dollar valuation?
That is the ultimate tension here, isn't it? I mean, we're talking about a company whose CEO, Anthony Noto, is openly talking about becoming a top 10 financial institution.
Yep.
And at the same time, the street is just suddenly slamming the stock with severe downgrades and massive selling pressure. Okay, let's unpack this. Let's start with those immediate market shockwaves.
Let's do it.
The market pressure really came from a 1-2 punch of negative news right out of the gate in January. The first punch was the most dramatic headline. On January 7th, 2026, Bank of America resumed coverage on SoFi.
And they didn't hold back.
No, they did not.
That's right. They slapped an underperform rating on the stock, and they set a very specific $20.50 price target. That is an aggressive call against a stock that had been trading much, much higher.
And the market reacted instantly. That single note triggered an 8% drop in the stock.
An 8% drop.
But that wasn't even the biggest single-day loss. Did you see what happened the day before? On January 6th, the stock dropped nearly 10%, a double-digit move. And that was purely driven by capital structure mechanics.
That near 10% move was a direct reaction to what we call the dilution hook. It happened because the underwriters of SoFi's recent major share offering, they exercised their options on $1.5 billion in shares.
Okay, let's stop there. Let's clarify this for the listener because technical jargon can be dense. What exactly does it mean when the underwriters exercise options right after an offering? And why does the market see that as such a negative?
It's purely mechanical, but the optics are just terrible. SoFi completed a necessary $1.5 billion share offering on January 2nd.
Right, to raise cash.
To raise fresh capital, strengthen its balance sheet. That raise itself increases the total share count, which is inherently dilutive. But when the underwriters, the firms that manage the sale, immediately exercise their extra options, they're essentially dumping additional new shares into the market way faster than expected.
So it's not just the planned dilution for the capital raise. It's this immediate extra flood of shares hitting the market that makes the float bigger and instantly compresses the value of every single existing share. It signals to the market that there's just this huge supply waiting to be traded.
Exactly. The market already prices these growth stocks for, perfection, and any hint of capital instability or excessive supply is punished severely. It just poses the immediate question, why, if the company's doing so well fundamentally, why did they need to sell such a large tranche of shares, and why did the market feel the need to exercise those options so quickly?
That's what we're here to investigate. Is this panic justified by the numbers, or is the market just ignoring the long-term vision that's been laid out by CEO Anthony Noto?
To assess that, we have to look past the momentary panic and focus on the engine room. The financials, reflected in their Q3 2025 results, they tell a story of powerful, profitable growth.
Okay, so lay out the best data point from Q3 2025 that the bulls are still hanging on to.
It has to be the profitability. They weren't just growing fast, they were growing efficiently. Revenue growth over the previous 12 months was a stellar 34%.
That's huge.
But the crucial point for a fintech that's targeting traditional banking territory is the margins. They reported a net profit margin of 19.46% and an operating margin of 15.62%.
For context, why is a 19.46% net profit margin so significant for SoFi specifically?
It's absolutely essential. It's the final metric required for potential inclusion in the S&P 500 index. S&P inclusion requires sustained profitability.
Right.
Hitting these kinds of margins signals that they have achieved operational efficiency far earlier than many of their high-growth competitors, making 2026 inclusion a genuine possibility.
So the margins support the index inclusion, which supports the stock price.
Right.
But wait, I have to introduce some friction here. They reported total debt at $2.81 billion USD. Isn't that still a concerning number for a high-growth tech platform, even if they have strong cash reserves?
It is a fair challenge.
Are they financing this growth too heavily on debt?
I see why you'd ask that, but when you look at the balance sheet context, the debt is quite manageable. They had $3.27 billion USD in cash reserves to offset that debt.
Yeah.
And that results in a low 32% debt-to-equity ratio. In the financial services world, especially when you are originating loans, that is considered a moderate, even conservative position. They have the capital and liquidity to manage their current liabilities.
All right, so sound financials support the ambition. So let's talk about that ambition. CEO Noto's stated goal of transforming SoFi into a top 10 financial institution with a target valuation of $1 trillion USD.
$1 trillion. It's audacious.
It's extremely audacious.
It is, and the company is guiding for aggressive continued success. They raised guidance for 2026. They're projecting revenue growth greater than 25% and aiming to push that net margin even higher to 20%.
And the foundation for this bull case is?
It relies on aggressive cross-selling, aiming for 3.5 million members using multiple diversified products.
And this ambition is backed up by serious technological innovation that, frankly, few other banks are touching. We have to discuss the SoFiUSD stablecoin.
Absolutely. The launch of the SoFiUSD stablecoin on December 18th, 2025 is the critical strategic differentiator. This positions SoFi as the first national bank to operate on a public blockchain. This is not a gimmick.
No.
It is a foundational change in infrastructure.
And why is that infrastructure change so important to the long-term trillion-dollar thesis?
Because it addresses a massive cost center, payment processing, and cross-border transactions. By leveraging public blockchain technology, SoFi potentially disintermediates, traditional banking rails and massive processing costs.
I see.
This ability to reduce transaction friction and cost is what allows them to target that very high 20% net margin goal while simultaneously fueling explosive member growth. It's the technological edge they believe will make them scalable in a way traditional banks just can't match.
Okay, that sounds like a phenomenal story. Strong financials, S&P inclusion potential, revolutionary fintech architecture. But now we have to interrupt that sunny narrative with the cold, hard drama that the market is clearly picking up on. The problem is the boardroom sentiment right before the crash didn't exactly match the external guidance.
You're referring to the insider selling that occurred right when the stock was peaking.
I am. Amid the stock highs in late December 2025, we saw a cluster of insider sales. This signals that those closest to the action felt the stock was priced near its zenith in the near term. For example, Kelly Kioff sold 256,948 shares at $27.14 USD on December 23rd. And even more significantly, Jeremy Rishel dumped a massive 2.4 million shares at $26.64 just before that on December 17th.
And while insider sales can sometimes be pre-planned for tax or liquidity reasons, a cluster of selling like that,
At those volumes
and at those prices, it's just difficult for the market to ignore when it's paired with a subsequent downturn.
And it brings us right back to the immediate crushing pressure of that recent capital injection. SoFi needed to raise that capital, which is fiscally responsible in an uncertain macro environment, but the market's reaction proves that the need for capital outweighed the momentum from that fantastic Q3 report.
And that tension is driving the deep division among analysts right now. The bear case is focused on three things: the rich valuation, the immediate dilutive pressure, and the tight credit cycle suggesting higher risk in their core loan business.
And we see that worry crystallized in the analyst disagreement. While the consensus tends to be a cautious hold, the aggressive bearish calls are far louder. We already mentioned Bank of America's underperform at $20.50.
Right.
But Keefe, Briette, and Woods has been even more consistent, reiterating a straightforward sell at $20. This stands in stark contrast to firms like Goldman Sachs, which maintain a more neutral, balanced position. The street is genuinely split on whether this is a groundbreaking technology company or just a heavily priced bank in a cyclical sector.
To understand the intensity of the market reaction, we absolutely must contextualize it within the broader macro environment of early 2026. The market is not just reacting to SoFi's balance sheet, it's reacting to systemic instability.
So what are the biggest macro pressures hitting a company like SoFi right now?
Well, geopolitical tensions are high. We're seeing persistent inflation combined with fears of a U.S. economic slowdown. If the economy slows, credit tightens, and that directly impacts SoFi's primary growth engine: high risk, high growth loan origination.
Of course.
And while current neutral rates, around 3.5 to 3.75%, they support a robust net interest. Margin SoFi's is currently 5.8%. The overall instability increases regulation and, critically, the cost of capital for any fintech attempting to scale.
So if we connect that macro risk back to the Bank of America downgrade, what they're saying is not necessarily that SoFi's current valuation is wrong, but that the risk profile for a high-growth lending business in a tightening macro environment is just too high.
Precisely. They are modeling an increased macro risk that could severely compress those high margins we just celebrated.
Yeah.
Their timing suggests they're prioritizing the external environment and capital structure over the previous quarter's phenomenal numbers. Let's remember, before this dilution fear took hold, Q3 was a fundamental beat.
A huge beat.
EPS was $8.11 versus $9 expected, and revenues were almost $950 million, growing 37.7%. The fundamentals were exceptionally strong.
Which raises an important question. Why the urgent capital raise and subsequent dilution if the Q3 numbers were so great? The $1.5 billion capital raise has to be seen not just as a balance sheet booster,
No.
but as the high cost of executing that technological vision, especially in a highly regulated sector.
That's the structural element.
Hey.
SoFi is pushing the regulatory envelope by launching a stablecoin and integrating public blockchain tech. Becoming the first national bank on a public blockchain means dealing with intense, increased regulatory scrutiny.
Right, the costs that come with that.
Exactly. Executing that massive technological roadmap requires immense, expensive capital to satisfy both growth needs and regulatory capital requirements. The dilution is the financial admission that they are paying a very high price to scale and secure their position as a regulated technological juggernaut.
So the market isn't just reacting to the dilution itself. They're reacting to what the dilution represents. The massive cost and regulatory hurdles inherent in pursuing a trillion-dollar vision in modern finance.
I think if we synthesize this, the market drop represents a prioritization shift. Investors are facing a choice between SoFi's extreme, long-term ambition, the trillion USD goal, the stablecoin innovation, and the immediate reality of capital markets. Dilution, insider sales, and tight credit cycles.
And the market has made its choice.
The recent action proves that in the short term, the market will always prioritize capital concerns and regulatory reality checks over explosive technological dreams. It is, the cost of being an innovator in finance.
The tension in the SoFi story couldn't be clearer. We have a company demonstrating robust operational efficiency, signaling profitability with a 19.46% net margin. But that financial strength is immediately being countered by the urgent need for a massive capital raise and subsequent dilution event. In a market riddled with macro uncertainty, capital security has momentarily silenced the growth narrative.
And this brings us back to the biggest strategic dilemma facing the company. As they integrate public blockchain technology via the SoFiUSD stablecoin and pursue this $1 trillion valuation, how much short-term dilution and capital risk is acceptable to execute a vision of that unprecedented scale?
A huge question.
And will regulators allow this kind of growth path to continue without imposing even higher capital requirements that would force even more dilution down the road? That's the tightrope walk that SoFi is on.
That is the ultimate trade-off you, the investor, have to weigh. Does this latest news, the Bank of America downgrade and the immediate capital dilution, change your thesis on SoFi? We want to know. Share your bull or bear case for 2026 in the comments.